My name is Aureo Pinto. I am an accountant, an enrolled agent, and my specialty is tax preparation, tax compliance, tax planning. And I am also a registered financial consultant where I do full-blown financial planning as far as insurance planning, tax planning, investment planning, and retirement planning. So like C said, tax season is over. Now what? It's very important. It's not only between January and April that you need to worry about your taxes. It's something that happens year round. Everything that you do during the year that's money related, any type of transaction, any type of financial impact that you might have, it all has a tax impact. So it's good to now start planning for next year's tax return, make the process easier and more accurate. So I hope everybody can see the screen with no glitches. And I seem to be having it. There you go. Okay. So today we're going to cover three things. Learn why you received a large refund and what to do with it, and also how to avoid getting a large refund on a consistent basis. You should not be getting large refunds because basically you're getting back some of your own money and you've been giving the government a loan in the meantime. So we'll go through that in more detail. The second piece is learn why you owed a lot of taxes, why you owed a large amount, and how to avoid that from happening again. That's very important because if you owe anything over $1,000, you will be subject to penalties and interest. So that's an incentive to not owe a lot. And we'll go through the process of how to get your numbers where the tax liability is very close to the tax payments that you've made. And the third part would be what should I do this year, which is now general tax planning. How do you prepare for the next tax season? How do you make sure that your tax situation is accurate as you go along this year? So any transaction that you make, you get a promotion at work, you get more money, you start a different job, you start your own business, all of that we have to incorporate it this year so that when you actually prepare your tax return next year, you're very close to your tax liability. So possible reasons for a large refund. There's many, but these are the four that I've seen more this year. Over withholdings. You have more taxes taken out of your salary as you go along. So you've been getting less of a net pay, but more of it has been going to taxes. So at the end of the year, you wind up with a very large tax refund. Now, some people do that on purpose because that's the only way that they'll be able to save. It's like a forced savings, or they want that money to go on vacation, or they want it for a particular large item purchase. They want to maybe purchase a car or a house. They want to put money toward the down payment. So they do this on purpose, but you should not be getting large refunds. You should be getting the amount that you are due as part of your regular pay. So at the end of the year, there's very little that you owe or very little that you'll get back within a couple of $100, because then that impacts your cash flow during the year, and it means that you've been getting more in your paycheck as you go along, which is what you want, because then you can do a lot more money, a lot more with that money. The second reason is large estimated tax payments. I had a couple of new clients who were referred to me. When I completed their tax return, they had large refunds, and it was because the prior accountant, for some reason, estimated that they needed to make larger payments and pay more taxes. But whatever income they thought was going to happen didn't really materialize during the year. So they wound up getting a large refund. So also look at your estimated payments. So that's the conversation you need to have with your accountant based on your current income. If you expect that income to be the same in the following year, maybe you do not need to make large estimated tax payments. The other reason would be the one-time credits, energy credits. You have a house, you install new windows that are energy efficient or storm doors, you get an energy credit. That can result in a large refund. And that's a one-time deal. That's not going to happen on a recurring basis. If you purchased a new electronic vehicle, there was a purchase credit between 7,000 and 7,500, depending on your income. That might also be just a one-time deal unless you buy another electric vehicle next year and the credit is available. There are multiple credits for multiple years with regard to solar panels. So if you install solar panels, you can actually get an energy credit from anywhere from 10 to 15 years. So that'll result in large refunds too. And that's something you can take into account and kind of have less withholdings from your job so that it kind of balances out at the end of the year. And the fourth bullet is very important, and I added that over the last couple of days. Review your return with your accountant. Go through your tax return with your accountant. Ask him, why is it that I'm getting a large refund? And also, if I owe a lot, why is it that I owe a lot? And go through the numbers with him. Go through, ask the question as to why you're getting a higher refund than what you expected, or higher refund than what you've had in the past. And also on the payment side, why is it that I'm paying more than I've paid in the past? And I don't like to, I don't want to say that, it could be something wrong that the accountant did, but I don't know if you've heard in the news over the last couple of days, there was this accountant that they called the magician who wound up earning over $15 million or so, defrauded the IRS, the federal tax system, for over $100 million over the last 10 years because he would put false business deductions on tax returns so that people would get large refunds. He would charge a higher fee. The person really didn't care what they were paying because they were getting these large refunds. A lot of these people didn't look at their return. They didn't realize what was going on. Some people did, and they were in on it. Some did not. The majority of them did not know. They innocently took the tax return, signed off, accepted it, got the large refund, paid his large fee because he did this incorrectly. So look at the numbers, review them with your accountant, ask questions. Why am I getting a large refund? Why am I paying more? And if there's a certain line item on the tax return that doesn't look familiar and you don't understand and it has a number on it, ask them, what is this number, for? What does this represent? He should be able to, or she should be able to go through it with you. Are there any questions in the meantime? We want to make this interactive so you can ask questions, you can put it in the chat, and it'll come through me. Okay. So now that you got the large refund, what do you do with the large refund? So like I said earlier, some people do it as a forced savings where they wind up setting it aside for a vacation. So they want to go to a cruise. They know they're gonna spend 5, 6,000. So, and they know they're gonna get the refund. They'll have uh, they'll have more taxes withheld. So at the end of the year, they wind up getting the larger refund, and that's how they do it. That's not really recommended. That shouldn't be the case. But if you do get a large refund, yeah, you can splurge a little bit, use it for, whatever it is that you want. But there's three things that you should do with it as well. One is pay down credit card debt. Credit cards are going between the lowest credit card right now is a 14.9%. And it's very rare. The credit cards are now, on average, are going 19.9%, 24.9%. And some of the department store credit cards are going for up to 30%. I was just looking at a statement from one of the credit cards issued by a big box store, and their interest rate is 30.14%. So if you have credit card debt, pay that off with part of the large refund, because that's money that you're spending unnecessarily. That the interest rate is very, very onerous number. The amounts that they charge are ridiculous. So pay down that amount as quickly as you can. Part of the large refund, you should also put it toward your emergency fund if you have one. If you don't, you should start one. And the emergency fund is basically what it says. It's for a case of an emergency. God forbid you get sick, you have to have more co-pays for medical reasons, for medicines. Your car breaks down. need new tires, anything that happens in the house, it becomes a very high ticket item. Your stove breaks. That's happened to us a couple of times. Stove breaks at the worst time. You have to go out and get a new range, and that can be $1,000 easy. So put money into a savings fund, into an emergency fund, or start one if you don't have one. And the other place that you should put money into is a Roth IRA. If start one, if not, if you already have one, add to it with the large refund. Roth IRA is probably at this point one of the best retirement plans that you can put money into. It's tax deferred and tax free when you pull the money out and you start making withdrawals from it after the age of 59 and a half. And there's other caveats with the Roth IRA. You have to have it in the account for at least 5 years before you can start withdrawing it and not pay any penalties. And you can start taking your money back out, whatever you deposited, even before you're 59 and a half, with no tax impact because you're basically pulling back your own money. But the earnings that you've earned at that point, if you're under 59 and a half, you'll be subject to penalties. But if you wait after 59 and a half, everything in a Roth IRA that you withdraw will be tax free. So that's something that we recommend people. Large refund, pay down as much of the debt that you can, add money to your emergency fund or start one, add money to your Roth IRA or start one, and spend a little bit. If you want to spend a little bit, take a little break, take a long weekend somewhere, that's fine as well. Any questions on anything so far? Okay, so now comes the difficult one. Possible reasons for a large tax bill. You file your tax return, you come back, your accountant gives you a tax return, winds up that you owe a lot more than what you expected. What are the reasons? On the withholdings, you did not have enough taxes taken out of your pay. That happens a lot, and over the last couple of years, it's happened much more frequently. So you need to look at your withholdings. If you're employed, you might need to file a new W-4, which you should be doing at the beginning of every year. And I'm going to cover that a couple of slides later. And adjust your withholdings every year to kind of bring it more into a balanced state with what you're actually paying. So under withholding is one of the larger reasons why you get a large tax bill. The second one is unexpected income. You either move to a new job, or you got an increase in salary that you didn't expect, or you got a promotion, and that increase in salary or that promotion might have bumped you into a higher tax bracket, and the withholdings might not be keeping up with the salary. The way the withholdings take are calculated, they take your estimated salary and they divide it by the number of pay periods. So they'll take whatever salary you're earning divided by 26, and they calculate based on your marital status and your exemptions what amount should be taken out by paycheck. So, and they do that once they start the payroll year. So later in the year, if you get a salary increase or promotion, that new calculated amount is now using the new salary from the point that you received it to the end of the year. It doesn't go back retro. And what happens is they're not taking out enough because very likely you're now in a higher tax bracket and the withholdings will not be enough. So that unexpected income causes another withholding. Sometimes also an additional job. You get a part-time in addition to what you're doing. So you might be getting a part-time for a couple of hours here and there. Many times the part-time has very little withholdings, if any. This year I saw some clients who had like an additional part-time, and there was no tax withholdings at all. So you wind up with an extra $5, $6, $7,000 of income a year with no associated withholdings. And that will lead to a bill. A side gig. Some people are now doing Amazon deliveries. They're helping out, on the Amazon. They get onto the delivery crew. They get paid by hour as a subcontractor. You also have Instacart. You have the Lyft, the Uber Eats. All of those side gigs, you're considered self-employed. So you do not have any withholdings on that income. You're basically getting paid as a subcontractor, independent contractor. Now you're responsible to pay the income tax and the self-employment tax on that. That's something that if you don't tell your accountant during the year that you're doing that, there isn't going to be any estimated taxes or anything done during the year to account for that. And that's going to lead to a large tax bill. That happened to one of my clients as well. She recently started uh, doing Instacart in addition to her full-time job. By the time she told me, she had already earned $6,000 and she had made no estimated taxes, no payments. So what I tell my clients is like during the year, if anything changes, any life events, a baby is born, you adopt a baby, you get married, you get divorced, you change jobs, you add a side gig, you quit your job and you go to full time on your own as a self-employed contractor. Let me know as soon as you can so that we can start working on the numbers and come up with an estimate of what your income will be for the rest of the year. And we can estimate what your taxes should be, and you can start making estimated payments every 3 months. The next bullet is self-employed. If you're a self-employed individual, let's say you have always been self-employed or you quit your job and now you're self-employed, you're subject to two different types of taxes. You're subject to income tax as well as self-employment tax. As an employee, part of your self-employment tax is paid by the employer. They pay half and you pay the other half. As a self-employed individual, you're paying 100% of the self-employment tax. Self-employment tax right now, it's 15.3% of your net income. So if you're making, let's say you're in a business, after you take out all your expenses, you wind up with net income of, let's say, $40,000. Your tax bracket would probably be 22%, but now you have to pay 15.3% of that $40,000 in addition to it. So you're paying 37.2% of every dollar of net profit that you make. That's a pretty big bill at the end if you have not made any estimated payments. So again, have a discussion with your accountant. Tell them, if you're going into a full-time job, as a self-employed individual, or you got more income, you have a higher contract at this point that you're going to be making more net income, have that discussion with your accountant so we can calculate that new amount due. And that's very important because with self-employment tax, you get penalized very easily for under withholding or underpaying your taxes once you do your tax return at the end. Another big cause for large tax bills is the unexpected higher passive income. Many people have mutual funds. Mutual funds during the year will pay dividends, they'll pay capital gains. So even though you might not get an actual check for the dividends, it stays in the account. Many people reinvest their dividends under capital gains. So the money that gets distributed to them, they wind up buying more shares in that mutual fund. So what happens is a lot of people don't realize that that dividend or that capital gain, even though you did not really receive it in your pocket, is still subject to tax. And over the last couple of years, when the market has been doing much well than it has in the past, a lot of the mutual funds have paid very high amounts of dividends and capital gains. And also at the end of the year, mutual funds start rebalancing their portfolio, and you'll wind up with more capital gains that come up at the end of the year. So by the time you get your 1099 in January or February from your broker, you'll wind up with a pretty big distribution of dividends and capital gains that, one, you probably didn't expect, or two, is much higher than what you had in the past and what you would expect, and there was no withholdings. Um, Mutual fund houses and brokers do not do any kind of tax withholding on dividend payments or capital gains unless you request it. And with the mutual funds, they really don't do it. Your regular broker might do tax withholdings if you have them pay out the dividends to you, but if you haven't reinvested, they will not do that. So you're going to wind up with more income being reported that is subject to tax, and there's no tax there to pay it until the end. Stock transactions that lead to capital gains, the same thing. You have your own brokerage account, you buy, you sell stocks. At the end of the year, when you get your 1099 that shows all the stock transactions, it shows up, winds up, well, it's very likely that you have capital gains. With the capital gains, you never pay taxes. Very few people will pay taxes on capital gains unless they know that the amount is high. And I'll give you an example of that. I have a client who has a fairly large portfolio and she manages her own stock accounts. Every couple of years, she'll go through her portfolio and she'll decide to sell the stocks that have already appreciated to what she thinks is the amount that is the highest. She doesn't think it'll go any higher. And she just wants to sell that one and then roll over that money into the next stock that she's researching that might be the next heavy hitter, which will be a good winner. 3, 4 years ago, she did that with two large transactions, two stocks that she had that really blew up in the market, and she wound up having capital gains of about $500,000. Luckily, she had told me halfway through the year when she sold the first stock that she had capital gains of about 300,000. So I calculated an estimated tax and I sent her a voucher so that she can make an estimated tax payment. And I asked her, do you plan to do any more stock transactions from now to December that you think might lead to a capital gain? And she said she did. And I estimated for that as well. And we did a tax voucher for that so that she can do the estimated taxes. By the time she filed her tax return at the end, we were off by maybe $4,000, which is not bad considering that she had over $500,000 of capital gains. Now, I'll also have the conversation with my clients when they do that, because if they have any stocks that they plan to sell that are losses that will result in a loss, I work with them to kind of harvest that loss so that they can apply that loss against a future capital gain. So if they have one stock that they know they're going to sell because it's a loser, and they have one that they know they're going to sell because it's gaining and it's going to be a big gain, I will recommend that they do that in the same year so that they can apply the loss against the capital gain and it reduces the capital gains ultimately. But it's still, she still gets the cash flow. They'll still get the money from both sales, but the tax will be much less. So we kind of calculate that stock by stock, and that's something that you should do with your accountant as well. Another thing that results in large tax bills, and people don't realize it until the end, is dependents that are no longer eligible. Like your child ages out, you can claim as a dependent your child if they're under 19, and you can claim them between 19 and 24 as long as they're in college. Once they finish school or they drop out of school and they start working on their own, they really are not your dependent anymore. And there are a couple of exceptions, but that's on a case by case basis. Uh, and that again happened this year with one of my clients. They had 3 kids. One graduated from college. The other two, they were all like a year apart. The other two were in college. They decided to drop out of college. They didn't want to complete college at this point. They rather work. They wanted to work, earn some money, figure out what they wanted to do as far as a career. But their income, surprisingly, was in the 50, 60, $70,000 range. So one was 21, the other one is 22. They're no longer eligible to be his dependent. So he basically lost 3 dependents in 1 year. That resulted in a pretty large tax bill for him because when the older child was in college, he was picking up a credit on the tuition and the educational expenses. So he lost that credit, plus he lost the dependency exemptions for the 3. So that's something to keep in mind. That's why I said anything that's life changing. Child gets born, but in this case, if a child ages out after 19, if they're not in college, they're no longer dependent. After 24, they're no longer dependent. So keep that in mind. Any questions on anything? I'll take a little pause and just any questions on anything that I've talked up to this point. If you have a particular example of something that you went through that is similar to this and you want to share it, that'd be great. Um, so I'll have an open mic.
We have a question in the chat. It says, my daughter had to file her own taxes, but she's 16 going to high school. Isn't she still a dependent?
Yes, if she's in high school and she's 16, she would still be a dependent because at that age, she's probably not making more than two, three, $4,000 a year. So at that age, she's not really paying for more than half of her support. And that's one of the rules that the IRS has laid out. You're a dependent. You need to support your dependent for at least half of their support. You need to provide at least half of their support for them to be your dependent. At 16 in high school, probably has a part-time job, probably not making enough to support herself. She is a dependent. She would continue being a dependent. Yes. And even though she filed her return might have been filed for two reasons. One, um, actually, the only reason would be for her to get back any taxes that were withheld. So if she had a little bit of federal tax or state tax withheld, that's probably why she had to file so that she could get that back. Otherwise, she probably didn't even have to file if she had no withholdings. Did that answer your question? Yes. Okay. All right. Any other questions? Anything else? Um, anything that I brought up about large refunds, large amounts due, the self-employment piece of it, the side gig, the passive income as far as dividends and capital gains, anything in those areas? Okay, so let me. Okay, so how do you correct a large refund or a large amount due? Every year, January, the employers, most of them don't, but they should be giving out new W-4s and new 2104s for New York State for you to fill and to update. When you do your W-4, make sure that your marital status is correct if it's changed during the year. That's a big adjustment. The difference between single and married filing joint is a pretty big gap. There's an algorithm that the IRS follows because if you're married filing joint, your income will be taxed in a certain way. Your spouse's income will be taxed in a certain way, depending on the dependents that you claim on your W-4. But then at the end of the year, when you combine your income, 99% of the times, the withholdings have not been enough because you get withheld based on only your salary. So you get tax withheld based on your salary. Your spouse gets their tax withheld based on their salary. When you combine both salaries, you're now at a higher tax bracket, but the individual brackets that you were in were not enough to cover the new tax. So very likely you'll be owing money. So what I tell some people sometimes, and I go through the numbers with them, you can claim yourself as single so that they take out more money, and then your spouse can be married filing joint. The combination of you being withheld at the single rate and your spouse being withheld at a married filing joint rate brings you closer to your actual tax liability at the end of the year. The fact that you file single in the withholding certificate has no bearing on your actual marital status or how you will ultimately file your return. It's just a withholding table category, if you will. So it doesn't mean that you are single. It doesn't mean that you're going to file a single. It just means that you want to be withheld, you want to have taxes withheld as if you were single so that they'll take out a little bit more. And this works out when you owe a lot of money because that kind of brings you closer to your actual tax liability. And the same for the state level for the 2104. Now, one thing to be mindful of the 2104, there are two questions. One asks, are you a resident of New York City? Yes or no. Are you a resident of Yonkers? Yes or no. New York City, the five boroughs of the city, and Yonkers are the only two cities within New York State that have their own additional local tax in addition to your state tax. So if you live in New York City or in Yonkers, you're paying federal tax, New York state tax, and local tax. If you do not check that box, if you live in New York City and you do not check the box uh, for the allowance in 2104 for either New York City or Yonkers, your employer will not withhold New York City or Yonkers tax, even though the address will show New York City or Yonkers. They go based on the checkbox. Some people will check no because they don't know the impact that it'll have. But if you do not have New York City tax or Yonkers tax withheld, you can wind up paying up to $1,000 at the end to New York State if your income is 80 or 100,000 or so. It's a particular tax rate that is applied to the state tax rate. So New York City, I believe, is 15% of whatever the state tax is. Yonkers is 16, I think this year was 16.5% of whatever your state tax is. So for every $1,000 of state tax that you owe, if you're a Yonkers resident, you owe an additional $165 or so. So if that doesn't get withheld as you're going along, that's going to increase your tax bill to New York State at the end of the year. So that's something to be very mindful of. Make sure you check the box. Some employers, for some reason, depending on the payroll service that they use, are not able to withhold local taxes. That's happened to a client of mine who uses, I believe it's Paycheck, uh, as their payroll server. They're not able to withhold local tax. So in that case, what you do is you, in consultation with your accountant, you calculate what an estimate of what that amount would be. And in your 2104, you can ask for an additional amount to be taken out. For both the W-4 and the 2104, you can actually put a dollar amount of additional amount to be withheld. So in New York State, if for whatever reason your local taxes are not withheld, you can add in one of the boxes, say, I also want an additional amount of 20, 30, $40, whatever it is, to be withheld. And that's how you make up that difference. So don't rely on your employer always being able to withhold at every level of taxes. Keep track of your pay stub. Look at your pay stub. Make sure that there's enough federal, state, and local taxes being withheld. You can review that with your accountant, send them a copy, say, does it look like I'm getting enough withheld? Go back to your employer, see what they're using as your marital status in the withholding statements, and update your W-4 and your 2104 for federal and New York State. And the last line that I have on this slide is self-employment taxes. Again, I said earlier it's 15.3% that you owe on every dollar of net income as a self-employed individual, but you owe that in addition to your regular income taxes. So whatever tax rate you're at, as far as the tax bracket, you add the 15.3. That's the total amount of taxes that you would owe. You have to make estimated payments on that. And I put must. So if you're a self-employed individual, you must pay estimated taxes if you have a net income. IRS in New York State will heavily penalize somebody who's self-employed and has not paid estimated taxes. If you wait to the end to pay 10, 15, $20,000 in taxes, the penalties and the interests are tremendous. So be mindful of that. Make sure you have a good estimate of what your net income would be on a monthly basis or on a quarterly basis. Look at what you've done so far, your total income, total expenses. Look at the expenses that you can deduct against your gross income. What I tell my clients is every dollar that you spend in an allowable expense that helped you generate a dollar of income, that's deductible against that income. So always always remember that, and keep a journal of all your expenses. If you use your car, keep a journal for the mileage as well. That's very important. At the end of the year, you'll be surprised how many expenses you might have forgotten or you might have left out that you didn't have invoices for. Mileage is one of them. Keep a journal of the mileage, the miles that you drive for business if you're self-employed. Keep track of how often you use your cell phone for business if you're self-employed. 10% of the time, 20% of the calls are all business related, or that's deductible. So I covered the three ways of adjusting your withholdings. At the federal level with a W-4 if you're an employee, at the state level and local level, the 2104 if you're an employee, and estimated taxes, estimated vouchers for taxes if you're self-employed. Any questions? Is the amount still 600 or more to get issued a 1099 for a business? Yes, it's still 600. So if you earn more than 600 as a self-employed individual, you'll get a 1099. If you earn less than 600, the business will not issue you a 1099. But you should still report it. That's the other thing. A lot of people, if they don't get a 1099 because they earn less than 600, they will not report it because they figured there's no reporting mechanism. I didn't get a 1099, so I don't need to report it. It's still reportable. It's just that there's no documentation that was already filed with the IRS by the employer. So yes, 1099s are still a thing. And now there's 1099s, miscellaneous 1099s and ICs. There's going to be more 1099s issued in the future, especially for people who sell online through Amazon, eBay, Poshmark. All of those businesses, all of those companies will start issuing 1099s to vendors who use their platform if the sales reach a certain amount or if the transaction number reaches a certain amount. And that's been clarified over the last couple of years, and it looks like it's going to start happening in 26, starting January of 26 for the 25 tax year. So anything that happens in 25 will get reported in a 1099 if you have an outside business selling through one of those platforms.